Everybody to the Managing Patronage Refunds for Worker Cooperatives workshop. And I am Luis Sierra, Cooperative Development Specialist with Northwest Cooperative Development Center. And today's workshop really comes out of our year's worth of relationships with worker cooperatives across many industries. And we're always excited and proud when the cooperatives we assist end up having a great year that allows them to provide their members a patronage refund. But we also sometimes see that cooperatives take a very short view of their success and don't imagine that some years in the future might not be as good as the one that they're having right now, and end up making decisions that sometimes weaken them in the long run. So our goal today with this workshop is to help you get a solid understanding of the legal and financial framework that cooperatives needs to understand in order to make good financial decisions that will help with long-term sustainability. So to do this, I've invited Brian Dahlk of Wegner CPA to provide the framework for cooperatives to manage their equity through patronage refunds. So he's going to provide the tax-related context for managing patronage refunds, and it will also introduce us to the terms that are commonly used by accountants and cooperatives, so that we can all speak the same language. And to illustrate the concepts that Brian is teaching us, I've invited Leah Brissenden of Bellingham Bay Builders and Eric Miller of Working Systems to share with us a particular year's patronage process. And those are going to highlight the different ways that co-ops can manage their equity through decisions that they make about their patronage refunds. And yes, and you'll be able to review this. We're recording right now. So if some of this is maybe too much at one time, you can come back and revisit the training. So I think now I would like to hand it over to Brian.
Thank you, Luis. I'm going to attempt to.
I stop share.
Okay.
And so I will also ask, I meant to do a little housekeeping here. The way that we're going to go through this shortly before you start, Brian. Brian will give his presentation and we'll take some questions at that point. And I invite you to write your questions in chat, and then we can get back to them, and I'll call on you for clarification if needed. And then we'll hear from Leah and Eric. And after those two case studies, then we'll take more questions on those specifically. And I'm going to ask, make sure that you are all muted during this part and selectively unmute when we get to question and answer. So now, thank you very much, Brian.
Oh, great. Luis, can you see the slide?
No, it's not shared yet.
Oh, okay. Well, let's see what I can do.
Now it's shared.
Okay. So you can see the cooperative patronage dividend slide?
It's ready to go,
great.
Yes.
Okay, wonderful. Okay, well, just a bit about myself. I am an accountant who works at Wegner CPAs. The firm itself is pretty much an all-encompassing accounting firm, but we do have a very strong specialty in working with cooperatives. We work with about 250 co-ops all across the country. And among those are many, many dozens of worker co-ops. And I have a personal background in co-ops myself. I was a member of 3 different housing co-ops back in the day, and my first real job out of college was working for a housing co-op. So now pretty much all I do is cooperatives, income taxes, audits and reviews, and consulting services. Um, and so cooperatives are very much a passion of mine professionally and personally. So starting things out at a very high level, just, what is a co-op that allows one to do this great thing called the patronage dividend? Um, the there are formal definitions that one can access. Like according to the International Cooperative Alliance, there are 7 formal definitions of cooperatives. The IRS, which is one important entity that we are interested in knowing how they treat cooperatives. Interestingly, the IRS does not have a specific definition. Um, the when you want to take tax advantage of the benefits of being a cooperative, you file a special form that cooperatives are allowed to file called the 1120C. And the very first time you file one of those, you assert that you are a cooperative by attaching some of your governing documents. And then what the IRS does is they look at 2 particular criteria in your governing documents to satisfy themselves that you're operating on a cooperative basis. They want to see that you have something set up so that you're democratically controlling the organization among your members by a one member, one vote concept. And you're allocating the profits based on the business done with the co-op. If you do satisfy those things, then the IRS allows you to operate under this very special subsection of the IRS it's called Subchapter T, which you may have heard of. Subchapter T is the cooperative component of the IRS code. Yeah, so one of the basic concepts of the patronage dividend is that it is derived from the cooperative earnings. If you want to pay a dividend to your members that's not derived from the cooperative earnings, you can do it. It's just not going to be a patronage dividend. You're not going to get the special tax advantages from doing it that way. And we'll get to this in a bit, but there are different ways you can determine what the co-op's earnings are. They can be done on the book basis or the tax basis. And among the patronage dividends themselves, there are a couple different types that we'll get into a little bit later. There's a qualified, which is the more common one, and a non-qualified patronage dividend too. There are many great things about belonging to and working with a co-op. One of them is that you do get these special tax advantages if you're, officially set up and recognized as a co-op. Patronage dividends, if done correctly and properly, are tax deductible to the co-op. That's a unique form of a dividend. Most dividends for standard corporations are not tax deductible. Like take a corporation such as like Microsoft. If Microsoft declares a dividend to its owners, which is what corporations are supposed to do when they have solid earnings, that's all well and good, but that dividend is not tax deductible to Microsoft. But co-ops do enjoy the tax benefits of having their patronage dividends be tax deductible. And that is a wonderful benefit to being involved in a co-op. And so let's take a look at some of the basic terminologies that we throw around. As was mentioned, you can the financial statements of a co-op are basically what gives you the first foundation as to what the earnings actually are for the year that you can base your patronage dividend off of. Um, you can have financial statements that are done on the accrual basis, which means that revenue is recorded when it's earned and expenses are recorded when they've been incurred. That's what's considered to be the highest form of a financial statement in the accounting world. If you ever have financial statements that are presented according to generally accepted accounting principles, they will be done on the accrual basis. But the cash basis is also another way you could present financials if you want. It's basically you record revenue when cash is received and record expenses when cash is dispersed. And so either of those ways are ways that you can determine what your net income or net earnings are. And as a further wrinkle, the either of the first two ways we looked at just now, the accrual basis or the cash basis, can be considered to be the book basis of the financials. There's also something we call the tax basis, which is taking the book basis and modifying it for some select items which are treated a bit differently for tax purposes than book purposes. Usually the most common or the most significant difference is going to be depreciation. The depreciation, according to your book financial statements, is usually going to be different from the depreciation you can take as a tax deduction for tax purposes. But long story short, there are a number of different methods you can do to determine what your net income or net earnings are in the first place. We talk about a patronage dividend and a patronage refund. They're pretty much used synonymously, those two terms, patronage dividend and patronage refund. Also, net income, net earnings, and net profit are pretty much synonymous terms as well. Net surplus is another term that's often used as well to determine, what is available at the end of the year. That's more tied to your change in cash from the beginning of the year to the end of the year. So the net surplus is kind of the same as the net income under the cash basis, but it's probably going to be different from the net income under the accrual basis. So this subchapter T thing that guides cooperatives as they and the income taxes that are associated with cooperative transactions. Subchapter T is really not very long. There are 5 components to it, and it's only a few pages of reading. You could probably read the entire subchapter T text the IRS has in about 5 minutes, or maybe 10 if you're a slow reader like me. But it's pretty simple. It just gives some pretty basic outlines and a pretty general framework for setting up what a cooperative is and what you have to do to meet the cooperative guidelines, at least according to the IRS. So if you ever have a few minutes of free time in your hands and you feel like doing something productive and somewhat interesting, you can just take a look up subchapter T online and read all about it according to what the IRS official rules are. It should just take about 5 to 10 minutes. Subchapter T lays out 3 kind of basic concepts about patronage dividends and what needs to happen for them to be legitimate and tax deductible. They have to be paid on the basis of quantity or value of business done with their patrons. So you have to have some kind of system for determining how the patrons interacted with the co-op to determine how the patronage dividends are to be allocated. The second point, there has to be an obligation of the organization to do this, or at least consider it. We often refer to that as a pre-existing obligation that needs to be present. So you can't, a co-op can't have anything set up in its governing documents and then one day decide to do a patronage dividend. You really have to have something set up ahead of time in your governing documents that authorizes this, and which is determined by reference to the net earnings of the organization from business done with for its patrons. So it has to be based on the net income of the organization, and it has to be done, or it has to be derived from the actual business that you do with your co-op patrons. It can't, if a co-op ever had a another line of business, for example, besides the business it does with its members or its patrons, that additional line of business would not be eligible for the patronage dividend computations and allocations. Looking at the co-op just from a less IRS-y point of view and more of a co-op principles point of view, the co-op principle number 3 really is aligned with what we've been talking about up until now: members' economic control. And that concept is, members, and this is universal for all co-ops, not just ones for which the U.S. tax code applies, but members contribute equally to and democratically control the capital of the cooperative. And this benefits members in proportion to the business they conduct with the cooperative, rather than their capital invested. So that's one important point. You can, do patronage dividends in any number of different ways, but one way that's strictly prohibited is to do them based on the amount of money that somebody has invested in the co-op. If I invest 10 times more than my friend, who's also a member, I can't automatically get 10 times the amount of a patronage dividend at the end of the year just because of my investment level. Okay, so here's something that's fairly important to a worker co-op in particular. The patronage dividend has to be divided proportionally to the amount of business done with everybody, even the non-members. What does that mean? That means if a worker co-op has, say, 4 employees, 3 of the 4 employees are members, 1 is not a member, and the co-op has a positive net income for the year of $100,000, it can't do a qualified patronage dividend just to the 3 members equally for the $33,000 each. It has to take in the non-members' patronage into account as well. And so what it would normally do is take the $100,000 divided by 4 patrons or 4 workers, and then it would give the qualified patronage dividend to 3 of the 4. So each of those 3 would get $75,000, and the 1 non-member worker, in most cases, wouldn't get a dividend, and the co-op itself would be responsible for that final $25,000 and would incur the income taxes on that $25,000 left over. So you really should have things set up in your governing documents, your corporate bylaws, or if it's an LLC, your operating agreement, allowing for patronage dividends and noting the allocation formula. The allocation formula doesn't have to be in the governing documents, but it really should be either there or some formally established policy of the board. The metric for allocating patronage dividends for worker co-ops is usually based on the number of hours worked. So, somebody who works 2,000 hours for the co-op during a year, a profitable year, would get twice the patronage dividend as a fellow worker who worked 1,000 hours. That's usually the way it works. And remember from what I just said like 2 minutes ago, you do need to include the non-members in that calculation. But you don't you can use other methods. IRS subchapter T does not get into that level of detail as to how the patronage is to be allocated with respect to any specific method. For example, we work with a co-op of technology professionals. It has a few, about 5 members that do IT work, and they allocate their net earnings by the amount of revenue that each individual member brings into the co-op. We have a co-op of engineers that has 3 members, and they allocate their patronage by the relative amount of revenue that each individual member brings into the co-op. So you have quite a bit of flexibility to determine the way that you do your allocation. One thing you cannot do, and I've said this before, it bears repeating, you cannot allocate it based on the amount of financial investment. So somebody who invests more into the co-op can't automatically be given a higher dividend just based on their investment amount. It has to be based on the amount of business done with the co-op. That's the overriding guiding principle. Another thing you can't do is you can't automatically allocate dividends equally to everyone without giving any consideration to the amount of business done. If it just so happens that you have a formula, for example, if you're using hours worked for the year and every single employee worked the same number of hours, that's okay. That'll be a patronage dividend allocated equally to everybody just by coincidence. But that can't be your default method for patronage dividend allocation. Another wonderful tax benefit to the patronage dividend is that a co-op doesn't have to pay out the entire amount of the declared dividend immediately. It can retain up to 80% of the dividend. So when does that retained portion have to be paid out by? There is no official time limit. The co-op retains that amount indefinitely. And theoretically, at some future point in time, some future year, the board will decide to pay that out to the members who had earned it back in the year that it was declared in the first place. The entire patronage dividend, even the retained portion, is tax deductible to the co-op. And so the co-op can get the full tax benefit, even though it might only pay out 20% of that amount in cash. On the flip side, for a worker co-op, generally the entire patronage dividend is taxable to the members, even the retained portion. There are exceptions to this when a co-op is providing items and the members personally consume the goods and services. And the biggest examples of that are food co-ops and housing co-ops. In those cases, the dividend is not taxable to the members. So if you're a member of a food co-op and the food co-op has a good year and gives you a patronage dividend, that's not taxable income to you. But for every worker co-op, the dividend is taxable to the member. So to do a qualified patronage dividend, the qualified is just one of the two types you could do, the other type being non-qualified. You have to follow some rules. At least 20% of the dividend has to be dispersed in cash within 8.5 months to the fiscal year end. So for a calendar year co-op that ends December 31st, that would mean the cash portion has to be paid by September 15th. The retained portion, if there is any, is retained until the co-op decides whenever it does to pay out that portion to its members in the future. There's no time limit, and you do need to provide what is called a qualified written notice of allocation to the members as part of the dividend. Basically, that's an explanation as to what the heck this dividend thing is. You need to say this is a patronage dividend from this co-op, and this is the cash portion, and this other amount is the retained portion. And so people understand what they're getting. About 98% of the co-ops we work with, the dividends they declare are the qualified patronage dividends that we just went over. About 2% choose to do non-qualified patronage dividends, which is pretty much the opposite, the reverse of what we just talked about. In a qualified dividend, the co-op gets the tax deduction immediately, and the members get paid their dividend and get taxed on that dividend, close to right away. For a non-qualified dividend, we have the reverse situation. The non-qualified dividend is declared, but the tax situation doesn't happen until some future year when the co-op actually decides to pay it out. Like let's say the co-op declares a non-qualified patronage dividend, and then 5 years later, it actually pays the dividend to those members who were members at the time. Then at that time, the co-op gets the tax deduction, and the members have the taxable income. Sometimes people ask me what do things look like on the balance sheet for a co-op who does patronage dividends? Well, in the equity section, it's going to look pretty much like it does for most other kinds of corporations. You have your preferred shares, which are really provided by the investors. The common shares are stock or shares provided by the current members. And then we have a separate special section in the equity section of the balance sheet called retained patronage dividends, which are from the current and past members amounts that of the dividends that have been declared but not yet paid. So those are retained by the co-op. They show up in the equity section of the co-op's balance sheet until they're actually paid out. And then the amounts that the co-op earned during prior years that it did not pay out or declare as a patronage dividend are the retained earnings. So that really belongs to the co-op itself instead of the members. When a co-op has a positive net income for the year, should it automatically declare a patronage dividend? I would say no. There are quite a few factors that it should consider and contemplate when deciding whether to do a patronage dividend. It may want to strengthen its reserves. There may be a significant refund of shares that's coming up that it needs to have the cash available for. It may have major capital or renovation projects that it wants to do in the near future and it needs the cash for. There may be a significant receivable balance whose collectability is uncertain, and therefore the co-op might want to have extra cash around for that contingency. And there might be an expectation of upcoming economic difficulties. The co-op might have reason to suspect that the next few years are not going to be as good economically as the past year was. And so these are all things to consider in addition to the bottom line of the year that the co-op just experienced. But do remember that a co-op can declare a dividend and still retain the majority of it as the retained portion. And so that is a way to have the dividend and still keep most of the cash for the time being. And of course, there are member relations considerations. How are the members going to feel about not receiving a patronage dividend, even if they've experienced a positive year for the co-op? That's certainly something to consider and not take lightly. But anyway, that's one of the most positive things about being a member of a co-op, or at least being on the board of a co-op, is you get to argue about these things if you've had a good year. That's one of there are, co-ops are organizations that often have conflicts. This is one of the most positive conflicts you could have, is arguing about how to spend your profits. One of the mistakes co-ops make sometimes is that they decide to declare a dividend and retain a portion of that, which they're perfectly allowed to do if they do things correctly and follow the steps for a qualified patronage dividend. To the people who are maintaining the books at the time, it's very obvious to them who their members are and who is entitled to have that patronage dividend and the qualified portion of that dividend. They know that their 4 members are Phil, John, Sandy, and Melissa. It's obvious. Those are the members. Those who are the people who get the dividend and the retained portion. But then what happens is, 5-10 years later, there's a whole new membership of the co-op, and the people who are now maintaining the books see that there is this retained patronage dividend line on their balance sheet, but they really don't have a clue as to who earned that dividend in the first place. They don't have any easy way to find out who the retained portion really belongs to, which obviously is going to make it difficult for the co-op to ever actually pay that out at some future year. So, it sounds obvious, but I would encourage people, when they do have a patronage dividend and they do retain a portion of it, to take the time to set up a file to identify who the members are who received that dividend, and how that retained portion is allocated among those members so that they might actually be able to get their money some year in the future. Some tax issues. As we said, the patronage dividends are deductible to the co-op. For accrual basis, financial co-ops who present their statements on the accrual basis, the things are recorded when incurred. They can be deducted for the year if they're allocated and the cash is actually paid up to 8.5 months after the fiscal year end. So, let's say a co-op had a great year in the year 2024 and is right now deciding to declare a dividend for the year 2024. It can, as long as it pays out the cash portion of the dividend by September 15th, 2025, that dividend is tax deductible to the co-op for the year 2024. Meanwhile, for the member who gets the dividend, that dividend that they get is not going to be taxable income to them until the year 2025. So if I'm a member of a co-op and I get a dividend check today, even though it was for 2024 earnings, it's not going to be taxable income to me until the year 2025. So I won't have to worry about it tax-wise until next spring. So that's a really nice timing difference. The co-op gets the tax deduction in 2024, but the member doesn't have to recognize the taxable income until 2025. The 1099 pattern is the tax form that's used to notify the members and the IRS about the fact that the patronage dividends were declared. For entities in which the members actually personally consume goods or services like food co-ops and housing co-ops, 1099 patterns do not have to be issued. But for most worker co-ops, they are a real thing when a worker co-op declares a patronage dividend. So the general consensus among co-op accountants is that patronage dividends received from members of a worker co-op are not subject to self-employment tax. The IRS has never given a definitive ruling on this, but that is our position, and most co-op accountants and attorneys will take the position that it's not subject to self-employment tax. And the IRS, as far as we know, has never challenged that position. Here's what a 1099 pattern looks like. We do produce and file 1099 patterns for a handful of co-ops. Most of them choose to just do this themselves, which is fine. The most common mistake we see is when a co-op declares a patronage dividend and it decides to have a cash portion and a retained portion. We commonly see in box number 1 only the cash portion being listed. That is incorrect. The entire amount of the patronage dividend declared, even the retained portion, needs to be listed in box 1 and considered to be taxable income for the member. So be aware of that. That's something that folks often get wrong. There's also no specific instructions in the individual income tax forms as to where the 1099 patter or the patronage dividend income for members should be reported. Our recommendation is that the best place is on schedule schedule 1 of the 1040, line 8, which is the line called other income. And that generally, doesn't raise any possible self-employment tax issues with the IRS. If you want to, another option would be to fill out a Schedule C and report your patronage dividend on Schedule C, which would then flow into your individual income tax return. But be sure not to take any deductions from that or mix it with any other business activity you have, or the IRS is really going to question why there's no self-employment tax that was accounted for on the patronage dividend. On the IRS tax form for co-ops that is completed, there are 2 sections of it that are unique and distinct from the regular corporate tax return that a co-op files. One is this thing called the Schedule G, which allocates your activities among patronage and non-patronage activities. For the vast majority of co-ops we work with, all the activities, all the revenue and expenses would be considered to be patronage activities and fall into column A. The non-patronage activities should only be those things that don't relate to the co-op's business of providing services to its patrons, which are members and non-members. We often see tax returns prepared by other accountants that have the column A and column B numbers allocated by the amounts that are allocated just to the members, like as you would do to calculate the patronage dividend. But our stance is that that's not the best way to do it. Even the services or the activities done with non-members are still patronage activities for the most part, even if they don't all service the members themselves. Column B would only apply if there are co-ops that do things that are like a different line of business than their cooperative activities of serving their members and their patrons. And then the other schedule that's unique to co-op is Schedule H. This is where you would show your patronage dividends declared. Line 3A is the cash portion of the dividend, and line 3B is the retained portion. And so that is important because information here flows through to other parts of the tax return, and in a good tax software, the amounts that are recorded there will be tax deductible to the co-op. And so it will not include those dividends when it's calculating the taxable net income and the income tax expense for the year. And there are a few more patronage dividend allocation issues. When a co-op sets its metrics for determining the patronage dividend allocations, for a worker co-op, the most common metric is going to be the hours worked. It is permissible to use other methods. You can, for example, if you want to provide more productive workers with higher compensation, you can give them a bonus at the end of the year rather than just altering the patronage dividend system. That's certainly something that a co-op could do. But a bonus is, considered to be a taxable wage, and employer tax consequences are going to stem from a bonus payment. A co-op can use weighted allocations in its patronage dividend allocation method. It is allowed to some extent to say, workers who have been with the co-op for a long time should have a higher weight to their allocation method, because due to their seniority and expertise, they are being more productive to the co-op and helping it more economically than a newer worker. So that's permissible to an extent. If that's weighted too heavily, the IRS has, in some cases, disallowed that method. We take the stance that anything up to a weight of 1.5 is probably going to be fine. But above and beyond 1.5 is a bit of a risk that it could be disallowed if the IRS ever investigated it. And you can also base the current year's allocations of a patronage dividend on prior year's work as well as current year's hours worked, on the theory that the current year's earnings are not just a factor of the current year's work, they're also a factor of the work that people put in prior years as well. So if you want to do that, that's okay, that's permissible, but you just have to justify that. And I would, recommending documenting your method pretty thoroughly. And finally, Luis wanted me to put out a hypothetical calendar of how a co-op might go about deciding to do a qualified patronage dividend. So let's say it's a co-op that has a calendar year, fiscal year. So it ends December 31st. January, February are spent closing the books to determine what the income for the year actually was. So this example assumes that they are doing their books on the accrual basis. The decision on whether to do a patronage dividend will be made by the leadership in March or April, as well as the amount of the dividend and whether to do it all in cash or have a portion be retained. And then the cash payments of the dividend would be done in the spring or summer. They have to be paid no later than September 15th to be a qualified patronage dividend. And then the qualified written notices would be sent in conjunction with the cash payment. Once again, those are basically explanations as to what this check is, what's the fact that it's a patronage dividend, and if there's any retained portion in addition to the cash that they're getting right now. Then the final extended deadline for the tax return would be October 15th. So that would be done in maybe September or no later than October 15th. And then the 1099 patterns are issued in January of the following year. The 1099 patterns are always issued in January, even if a co-op has a fiscal year that's not the same as a calendar year. It doesn't matter. Those are totally a cash-based form that needs to be dispersed. It's due to the IRS. It's due to the member by January 31st and due to the IRS by February 28th. For other kinds of 1099 forms, there is a cutoff of $600. Any amounts, like if you pay a vendor $500 during the year, and the vendor is not an employee, that has to be you have to do a special 1099 to them in some cases, called a 1099 NEC or a 1099 MISC, and those have $600 cutoffs. And so therefore, sometimes co-ops think that patronage dividends also have a $600 cutoff, and for amounts under $600, they don't need to be issued. Well, for 1099 patters, the cutoff is $10. So anything $10 or more does have to be provided in the 1099 patter form. So my wish for all of you is that your co-ops have really good, healthy, successful years financially, so that you do have the opportunity to bicker and have heated arguments and conflicts about whether to do a patronage dividend, how much of the dividend it should be, and how much of it should be cash versus retained. So I wish for that for all of you.
Excellent. And Brian, you get a special prize for having your presentation end when we made our wildest guess. That's when it would end. So we're at 2:20. We're right on schedule, and got a few minutes for questions. And I've been copying a lot of these out of the chat. So I am going, and some of them are thematic. So I'm going to start with let's see. About non-qualified dividends. What kind of business structure or financial situation would make a business choose non-qualified dividends? And attached to that is what are the actual cases of non-qualified patronage and why the co-ops did that?
Yeah, there's only one or two that I've ever actually encountered. Um, and I don't know all of what was going on in their minds as to why they decided to do the non-qualified. I think that one of the considerations was that they wanted to provide something kind of symbolic to the members without giving out any cash, um, and they didn't need the tax deduction. So those are some of the main points, the reasons why you want to do a patronage dividend in the first place. You want to reward the members, give the members back some of what the co-op earned. You want the tax deduction for doing a qualified dividend, and you can part with at least some of the cash that you've earned. Um, I think for one of the co-ops I'm thinking about, none of those three situations applied, except for the wanting to give the members some kind of um, symbolic, if nothing else, reward. They could at least say that they've earned a non-qualified patronage dividend, and that they will get paid in cash someday in the undetermined future.
Okay. Next question, thank you, is what are some good tips for managing retained equity so that the co-op doesn't end up in a situation like the Northwest plywood co-ops that ended up selling to access their retained equity? And attached to that is in that same concept is as an example, participant says, I have equity in a co-op going back to 1994, and unless something changes, I can only access that through my estate or if the co-op sells or closes.
Yeah, I mean, that's a good question. A co-op needs to be doing good long-term planning to understand what its current and future cash needs are. Um, if a co-op has either retained patronage dividends that it theoretically is going to give out at some undetermined point in the future, or it has equity um, from other means like member equity that was invested, that it has stated that it intends to pay out at some point. But the co-op shouldn't just carry that on its books and then forget about it. The co-op really does need to make long-term plans for how it's going to deal with that equity, how it's going to manage its long-term cash situation to deal with possibly paying out that equity and meeting its future operational needs and other cash needs it might have. Co-ops sometimes can be short-sighted and um, consider their cash situation only with respect to what's coming up in the near future, when it really should be doing that and having a long-term plan for its cash needs that includes handling its equity, um, however that may be structured.
Thank you. And I'm going to use my special powers of facilitator to jump to one of the more recent questions that I think is great discussion fodder. And uh, our members tend to want 100% payouts. Is this typical, and what are the downsides?
I wouldn't say it's typical. Um, I guess the one answer is that given that it's a co-op, there is no typical thing about a co-op. Every animal is a little different. Um, but no, that really doesn't happen too often. That the members want 100% payout. Um, the and it's that's not necessarily an incorrect way to go about it. For a co-op to give 100% payout every year, if the co-op can afford it, and it's not going to be significantly impairing its long-term financial needs. It's certainly it's not necessarily a horrible or a bad approach to take 100% payout. But I at the same time, you might very well need to do some member education and explain to the members that even though the members did earn this money for the co-op, or even though the co-op did earn this money that the members generated for it, it does have a responsibility to be thinking about and considering its future needs, as well as rewarding the members um, with a large cash payout for the year that just ended. So, a good co-op does try to strike a balance between um, rewarding the members currently and planning for the long-term future. And oftentimes education is a big part of um, getting that balance right, and having a long-term, healthy, sustainable co-op going forward.
So I'm going to now invite Leah to tell us about Bellingham Bay Builders approach. And there are a few more questions that I've copied in the with the hope that we can return back to them, but I want to make sure that we end right around 3 o'clock. So I have noted that there are a few more questions, and I've copied them onto a separate page. And we will get back to them after these next two presentations. So, Leah, welcome.
Hi.
Are you
And
ready
yep,
to share your screen?
sure.
Great. Mhm. There we go. Now that's all set.
Okay. Well, hi, I'm Leah Brissenden. I work for Bellingham Bay Builders. We're a workers cooperative, but our business is residential general contracting. So we're a custom home builder and remodeler in Bellingham, Washington. And we're founded in 2004, and we started as a co-op. So we've been a co-op for 21 years now. It's been a long time, and had definitely some iterations, but it's been good. And my role here is I am the administrator, office administrator, and but I wear kind of a lot of hats, as most of us do in the construction world. So I do the admin side, but I also get involved in project managing, of helping our project managers doing things in their day to day. So yeah, that's a little bit about us. Some highlights, I guess, for how we deal with patronage. Big thing is our employees are our biggest asset here as a construction company. So we do a lot to also try to have great benefits for them. So one of the things we do is we have a SEP IRA that we as a retirement plan for them, and that goes into our thinking process when we talk about our patronage dividend at the end of the year. Some other thing is just straight profit sharing with our employees. So we also do that. Has been times when we haven't been able to, but for the most part, we really try to also profit share with our employees on top of our members. And then as a construction company, obviously we have sometimes big equipment or big expenses for the company that we may have to consider. So those are kind of all the things that happen kind of prior to what we're talking about when we have patronage dividends. And we happen to have, I think Brian was mentioning the weighted experience factor for seniority. We do have one of those in our equation. So this is just kind of as a starting point. These are fake numbers. They're not actually any thing that real from our accounting aspect. It's just kind of to help with the scenario. But say this was the net income you had there at the 89,000. Then if that was our number at the from our net income, then we kind of have these two buckets per se of the patronage versus non-patronage. And what those are is the patronage is the percentage of our owner hours relative to the entire hours of the company. And then the non-patronage would be the non-member owners percentage of that relative to the total company hours for the year that we are looking at. So you kind of then you end up with those two pots there that we're working with. And then obviously on those, we do have to pay taxes on them. So that's kind of just illustrating, you know, in this, the numbers won't go too much into them because they'll probably start to make my brain hurt sometimes. So not really focusing so much on those numbers, just to show you that, you know, then we have to pay taxes on our taxable income there. And then this is kind of, I guess, more the meat of it, where we get to talking about that weighted experience factor. So we basically are taking our members here. We have 7 members and 20 totals, and 7 of those total at our company are members, and the rest are non-members, working hopefully to be a member at one point. And so to get the weighted experience and factor, basically there's a bunch of equations that you do, but you kind of are getting a percentage at the end after dividing by total number of hours you have, as well as then total number of your hours for, like, say 2024 within the year. And then you times that by 0.05. We have to get the experience factor. And then you get a percentage, and then times, sorry, I have this little thing blocking my view of my, oh no, did I just unshare that?
No, it's still shared.
Oh, okay, somehow
Good. It's on the patronage hours, the second half of the second screen.
Yes, I somehow made that go away from me.
Oh.
I'm sorry. Oh, there we go. Okay. And then you get the weighted average. So then those numbers are what we are taking into consideration for those two pots. So this is kind of from that scenario of those numbers, this is what you would expect for your patronage. And so we have our patronage dividend here on the 1099 PATR side. And then what we have called retained earnings, which is we take the non-patronage numbers, times it by those percentages that we got from doing calculating experience factor and then getting the percentage. And then the PATRs, the patronage dividend, we pay out those once they're decided, and typically we pay them out all at once to our members. That doesn't always happen. It's, as a construction company, you have to watch your cash flow, but typically we are able to pay those all out in one go. And then the retained earnings are put into like our internal capital accounts, which then are paid out for us on a 3-year basis. So after 3 years, you would get those retained earnings. So for myself, I became an owner in 2021, I believe. And then so I will be getting my first retained earnings check for 2025 hours. Yeah, there you
go. So Leah, maybe I could add a few little notes. I
Sure.
worked with Leah to put together the presentation, and maybe could you slide back another slide or two? Let's see, going back to, yes, this page. Yeah, the one that comes after this.
Oh.
Yeah. So the thing to hide, no, not that one. The second, that's one. Yep, the one next, the one that comes after this one. No, you're going to the front. There we go. Yes, weighted average. Yeah. So the thing to highlight here is the.
Oh my gosh, sorry.
Nope, you were on that one. That was correct. Yes. That that for the hours worked in 2024, you can see that member B worked 16.79 of all the member hours. But based on, I think member B is a founder, so they've been there for many years.
Mhm.
So that's why they have 46,443 total hours that they've worked for the company since they started, since
Yeah, since
since
its
its
founding.
inception. So that their experience factor then bumps up the patronage allocation to 24. And it works the other way around for the newest members. Uh, like member A worked 13.63%, but because they have much less experience, less tenure, then their allocation goes down to 10%. So I think here, and we're also following what Brian recommends here in making that experience factor not add up to more than 1.5. So that's also, I thought, a notable thing to see here. Um, eh, and let's see. Yeah, those are the things that I wanted to make sure. We're looking at a lot of numbers, but especially want people to see that 24% patronage hours, the and the weighted average and how that works out. So there you go. You see a founder and a new member and how that that experience factor affects the patronage.
Yeah.
So Eric of Working Systems has joined us and is going to share with us their approach. So there's a little note here in the chat. Once you've seen one co-op, you've seen one co-op. And we're going to be seeing a little bit of that here today because Working Systems does things, some similar and some things that are unique. And I am going to run the slides for Eric, and I want to make sure that I find Eric. And there you go. And Eric, you are unmuted. So give me a second here
Awesome.
while I find your slide.
No problem.
Where'd you go? Where'd you go? Hold on. All right.
It's always hard to
10 more
find when you
seconds.
need it, right?
Yeah. No, yeah. 10 more seconds here. There we go. Do you see that now?
Awesome. Yeah,
Super.
we got it. All right. Well, I am ready when you are. So first of all, I wanted to talk a little bit about us. So we create custom software and web-based apps for labor unions. We, all of our employees, besides our general manager, because we need someone to bargain with, are also part of a union. We started in 1997 as Working Systems Inc. And then in 2019, we converted to a worker-owned cooperative. We started that cooperative stage with a loan from Shared Capital that has since been fully paid back, purchasing it from the original owners who were about to retire. And that was before my time, but I believe John helped out a lot in advising us during that time. As of current, we have 18 employees and 23 members. So 5 of those members are actually retirees. They are allowed to keep their membership status for a few years after retiring. So yeah, if we want to go ahead and head on over to the next slide. So some highlights. Leah talked a little bit about their experience factor. We have another way of sort of adding a wrench in our patronage calculations, which is a 4-year hours worked weighted formula. We also retain a portion of our surplus, and we have a revolving fund that we pay out additional distributions in later years from 1 year, which we will demonstrate some of that for you in just a second. If we want to go to the next slide. So I wanted to use, in talking with Luis before when we were preparing all this, we looked at a couple different years, and 2020 had the most interesting stuff in it to share with everybody. So this is a very watered down income statement from that year. And as you see here, we ended up with a net income of $276,104. Now that was an extraordinarily high net income year because of the COVID programs. Generally, that is not our net income. In fact, this last year, 2024, was our highest year besides this year, and it was $200,000 less. So that should give you some perspective. And it was actually the first year since I've started here, which we're coming up on 4 years soon, that we had a profit besides that year, a profit that was enough to allocate patronage. So just want to give that caveat. But if we want to go to the next slide. So this is all the hours from just 2020. I mentioned earlier how we use the current year's allocation plus the 3 previous years. The 2 particular employee numbers on here that I want to demonstrate something with. So one is the number 1 employee. And so you see their current year here. They only worked 1.7% of the total hours. And you look at employee 18, they worked 3.84% of the total hours for 2020. And when we go to the next slide, which considers the whole previous 4 years, the current year plus the 3 previous, you see number 1 bumped all the way up to 5%, and number 18 actually went down to 1.37%. So that happened because employee number 1, he started phasing out that year for retirement. So his current year was way lower in terms of his hours worked than the previous 3 years. And as you see there, thanks, Luis, yeah, the percentage jumped up 3.3%. And then when we look at employee 18, they actually cut in half their percentage of the patronage because they were a new employee. So for the current year, 2020, they might have had a higher contribution towards the total hours worked, but over the 4-year span, they did not. Some reasons that we take those 4 years of hours worked into consideration rather than just the current year is it, like I mentioned, since I've been here, there's only been 1 year that we actually had a net income that the board, which we'll talk about later, voted was enough to divvy out patronage, but it evens out patronage for years that we don't have net income. For those of us who've been here for 4 years or more, if we go all that time without patronage and then someone brand new comes in, well, I had to contribute my hours and my time over that full 4 years and didn't get patronage at all. And then a new member gets, so it sort of just evens things out a little bit. It also supports people who retire a little bit. Like I mentioned earlier, there is a few years after someone retires that they can still get patronage. And then of course it encourages longer tenure. So, I mean, it provides an incentive to stay with us in general. And so, yeah, if we want to go on to the next slide. So this is looking at the allocation and distribution. So like we mentioned, we had a net income of 275,000, but our board voted to allocate 100,000 to the members. And we're using 2020 as an example. Like I talked about, we looked at a couple different years to give an example of, but it shows a few things. That number one, we decided not to allocate all of the year's profit to members. And it also shows that we have a revolving fund, which we'll talk about more in the next slide. I already mentioned how this was also extraordinarily high, that the net income is a little deceiving because some of that comes from COVID grants, that loans that turned into grants. So we decided to keep 175 of this and turn it into permanent retained earnings. The way that decision comes to fruition is we have a board, and that board is made up of members. And so they discuss this once we kind of crunch all the numbers for the year. They discuss how much to distribute to the members, how much to keep as reserves. And then we also have an annual meeting of all membership, and in those meetings, the entire membership gets to give feedback on those decisions. And we're pretty open all throughout. I mean, that's the formal setting for it, but we have a very open organization. And so people can obviously comment outside of that time as well, but that is like where the big conversations happen. And so some reasons the board decided not to pay out the entire 275,000 into the patronage and rather kept some. We have a couple different reasons for that. So we knew that we had a large number of employees who were set to retire within the next 5 years after this. We had 5 people retire, and we have 3 more that the 3 years after that. So 8 employees who have years of experience, years of time with the company, that were all set to retire shortly after. And we knew we were going to have to invest in training and onboarding of those employees. It takes us about a year to onboard an employee. We call it a ramp up, all the way up to where they are billing clients at a same number as someone, or a comparable number as someone who's been there for over a year. So we know we invest in employees and getting them up to speed for a very long time, on top of the retirees going out. We also knew that our product that we serve our clients with runs on a very old coding format. And so we knew we had to do some futurization. And so the board saw that, and for the health of our organization and being able to have an organization that pays out patronage in the future, they decided to invest some of that into our future. And yeah, that was some of the reasons that they decided to do that. And I think that is everything I wanted to touch on with this slide. If we want to go to the next one. So this sort of shows the revolving fund. So you can see here, it shows everything that went out for 2020 in the second from the right column. And then we have the allocated and dispersed from 2020 and the retained allocated. But then all the way to the right, we also have the 2023 disbursement, where we dispersed an additional 25% of the retained allocated, and then kept the number of the retained allocated after that disbursement. So what's interesting, another thing to point out here is, besides the fact that we returned an additional portion an additional portion of what we retained in 2020, I think what's interesting is that even though QuickBooks is the primary accounting software that we use, really when it comes to patronage, the only thing that QuickBooks is doing the math for, so to speak, is really tracking the payouts themselves. All of this math and the record keeping of these disbursements is done in a spreadsheet in Excel. and so I think that is an interesting thing to show here, besides the remaining allocated disbursements that we had. If we want to go to the next slide. So here is an example of a 1099 PATR from that year. So this member pays taxes on the 9,823 in 2021. So even though they got an additional disbursement later, they paid on those taxes already. So they did not have to pay any additional taxes on the additional disbursement that they got later in 2024. Excuse me, in 2023. The disbursement they got, taxes were already paid, it was already reported, and they were good to go. So they only in the year that the entire distribution is allocated to them, that is the year they claim it on their taxes. The additional payouts later, they do not. And I think that's important to point out as well. And I think that's the last slide. Maybe I'm wrong. Besides the thank you slide, which thank you.
Super.
And that's me.
Thank you very much, Eric. Yes, and I'm going to hit the stop share button here and invite questions. There are still a few in the stack from the previous session. And I'll wait for folks to type in some questions in here for our two presenters here, and go back to the other questions. Okay. So some of the conceptual questions are, let's see, would it be possible to construct a buy-in process that leverages future retained patronage dividends? So that is a question for Brian. And I might ask for some more clarification from the person who wrote that question.
Yeah, I think I understand the question. If a member is paying their membership investment, their member share over time, and can some of that retained patronage that was declared on their behalf, can that be used in a future year to kind of serve as a part of the annual payment plan for buying into membership? So if I am a member and I had say a patronage dividend one year, and 5,000 of it was retained by the co-op, and I'm supposed to be paying in my member share $1,000 a year, can I just say to the co-op, well, for this year, could we just take the $1,000 from my retained allocation and apply it toward my member share? I think that's the question. And the answer is yes, if the co-op itself agrees and the member agrees. There's nothing to prevent that from happening. So you could certainly do it that way if you have the consent of both parties.
And Nate, if you wanted to unmute and clarify anything else about your question, you are welcome to.
Oh yeah, just adding a little bit extra. I was wondering if there would be additional tax benefits of doing so, just because since principal payments are tax deductible, I was wondering if that would prevent the taxation of those.
There wouldn't really be any tax consequences to doing it that way. I think it's important though to highlight what Eric said near the end of his presentation. I should have made this more clear myself. When a co-op declares a dividend and retains part of it, the full amount is taxable to the member at the time it gets the dividend, and so that part was clear. But what I should have emphasized was that when the co-op pays the retained portion to the member at some future time, it pays it in cash. that cash transaction is totally a non-taxable transaction. So if there's a declared dividend, a portion was retained in 2020, and then in 2025, the co-op decides, let's pay out this retained portion to those members in 2020. That's totally a tax-free transaction. The members already paid taxes on that retained portion. And so similarly, if you wanted to use some of the retained portion to kind of apply to members' equity purchase payment plan, that's fine, and there are no tax consequences to that transaction either.
Thank you. Another question, several years ago, there was an attempt to change the federal rules that would reclassify retained equity in cooperatives into a liability instead of equity. And is that still a potential threat?
To the best of my knowledge, it's not a serious threat. Me and the people I work with who are fairly well tapped into the co-op accounting governance rules are not aware of any serious threat to that at this time.
Thank you. And another question is, we didn't discuss on years in which you might have a net loss and how that is applied to either members or retained earnings. Or do we ask the members to write a check to the co-op?
In literally every situation I've ever been involved with a co-op, a net loss is simply a reduction in the retained earnings for the co-op, and there are no patronage considerations. But having said that, I've heard that it's technically possible to ask the members to make up for that net loss by writing a check to the co-op that would be somewhat of a reverse patronage dividend situation. So I've heard that that's technically possible, but I've never actually encountered it in any of my years working with co-ops.
Yeah, it's happened in agricultural co-ops, and that is just the ag co-ops way of saying we're out of business, we're closing down. When they ask members to write a check instead of receive a patronage refund. And I'll just add this note that, I mean, that's one of the reasons why, this question about our members want 100% of the patronage refunds this year. Part of the reason to not do that is to imagine that some year in the future you might have a net loss, and it's nice to have that to take some of the damage away, keep you solvent. And let me make sure that's okay. So let's see. Oh, yes. So I'm sorry, Isaac, we did answer that question about well, actually, no, this is a little bit more. What is the advantage of making a qualified distribution and having the member pay taxes on the lump sum of the allocation? Would it be beneficial to make an unallocated distribution so the company maintains tax liability in the event it went under? So that's a sophisticated tax question for Brian. It's the last question that you can see in chat.
I don't know if I totally understand the question. Let's see. What is the advantage of making a qualified distribution, having the member pay tax and lump sum of the allocation? Would it be beneficial to make an unallocated distribution so the company maintains the tax liability in the event it went under? Oh, unqualified distribution. So the company maintains the tax liability in the event it went under. Well, if you're making an unqualified distribution, yeah, the co-op itself doesn't get any tax benefit So you are essentially paying double taxes. The co-op doesn't get any tax deduction from the unqualified distribution, and the member still has the tax liability from getting some kind of unqualified dividend. So even though even if it's an unqualified distribution, it's still probably going to be a taxable event to the member receiving the cash. So you do probably have a double taxation thing going on.
We are at 3 o'clock. So I will deem the workshop to be complete. And this has been recorded so that you can review the examples and such. And again, want to thank Brian, Leah, and Eric for sharing all of your knowledge and your experience. Thank you very much.